What's up, my masterminds? This is Christina Jones here from Mastermind Assemblage, and I'm coming to you from Bowie State University here in Bowie, Maryland. And I'm joined today by Myron Adoteye, and I'll introduce him here shortly. Just want to give some quick updates. We are broadcasting from a historically black college in Bowie, Maryland. This is Thanksgiving week. And I just want to tell all my masterminds, thank you so much for being a part of this organization. You've been extremely incredible throughout 2019 with all of our different meetings and connections we've developed over this year. It's been absolutely fabulous, and I want to thank you again. And that's what I'm truly thankful for, are you. Everyone that's a part of this organization. So now today we are sitting down with an interview with Myron Adoteye, and Mr. Adoteye is joining us today to give us a deep dive into opportunity zones, and he'll explain a little bit what an opportunity zone is. I just want to introduce him to all of my listeners today, and that is Myron is the head of investor relations for Southbanc. And that's an opportunity zone fund. He's also a managing partner with High Street Capital, an exempt reporting advisory firm focused on multifamily and residential real estate development in Washington, D.C. So Myron, thank you so much for joining us.
Christina, my pleasure. Thank you for having me.
Awesome. So tell us a little bit about yourself.
You kind of got the high points, I guess, just now. Born and raised in Northern Virginia, one of three boys, the oldest. Both my parents are from Ghana. I was born and raised here, so I'm first generation. I have been back many times before the year of return. I would encourage everybody to go. If you haven't already, definitely make a trip to Ghana. You'll like what you see. Educated at Fordham University, got my undergrad and my MBA there. At one point in time, I had my Series 7 and Series 66 licenses. I got the credential. Built investment fund before, looked to raise money for different investments. Worked for a firm called REIS, which stands for Real Estate Information Services, and that had a focus on commercial real estate data. So getting really good at understanding different macro and microeconomic trends, construction data across multiple different asset classes, rising and falling in sales per foot, and rent per foot, and these sorts of things that impact so many of the large developments that happen across the country, and that dictate what takes place in our neighborhoods all over. So
awesome.
Yeah.
So you have just a broad spectrum of experience in this subject matter we're here to speak about, which has been a buzzword for me during this year. I think I heard it maybe mid-2019, opportunity zone, and I heard it on a real estate podcast, and not really sure how I could take advantage of it. But first I had to understand what it was all about, because I just kept hearing it over and over and over again. And as time went on, realized, okay, this could be something big.
Definitely.
So we'll just dive right into that.
Let's do it.
So Myron, I developed some questions, or actually received some questions from some of my team members from Mastermind Assemblage. So we'll just open up with that.
Sure.
Please break down the overview of what an opportunity zone is for someone with little to no knowledge of this concept.
Okay. So with that, I'm going to do what I like to call the too long didn't read version. In plain English, opportunity zones are designated areas around the country by the census that allow individuals and institutions to invest capital gains from the sale of a business interest, the sale of real estate, the sale of art, basically business gains
Sure.
into qualified investments for an extended period of time. Now, if they do that within these zones, what they're allowed to do is they can reduce the amount that they owe taxes on.
Okay.
On those capital gains. Everybody has, tax rates are different depending on where you are.
Sure.
You can have from 21 up to 35, 36% depending on where you are, what kind of gain you've got, how long you've had it, et cetera, et cetera.
Sure.
This allows you to reduce how much money you owe taxes on from the initial investment. So if you put $100 in, if you invest by the end of the year in an opportunity zone fund, which will invest in an opportunity zone business or a piece of real estate,
Sure.
and you hold that for at least 7 years, you don't owe on the $100.
Okay.
You owe on $85.
Okay.
Right? Now, if you invest by the end of 2021, you don't owe on the $100, and you owe on $90.
Okay.
Now, and this part is the big part. This is like the most important part.
Okay.
All right. So if you hold that inside this opportunity zone investment for 10 years, you whatever appreciation or whatever growth that capital gain investment has had, you don't owe any taxes on that growth.
Oh wow.
Right. So same $100, right?
Okay.
You invest in an OZ for 10 years or more. That $100 goes, let's say it grows to $200, or $300, or $500, right? That additional $100 or $200 or $400, you owe zero taxes on.
Okay.
Zero.
Wow.
Right?
Okay.
So as you can imagine, there's a reason why there's a lot of buzz about this. There's been a lot of articles written about this, a lot of press about this. And there's, in some instances, there's a little bit of hair on fire as it relates to it, but we're still very early on in the program.
Okay.
You have to keep in mind, 7 years, 10 years, etc., is a very long time.
Right.
10 years ago, Barack Obama was president.
Sure.
Right. And that seems like a long time from now. Right. So a lot can and does happen.
Okay.
But there's massive incentive for investors and institutions that have capital gains,
100%.
especially given the way the economy has been growing, really since 2010.
Yes.
But there's been obviously a lot of acceleration over the past couple of years, and people have realized capital gains with the stock market doing its stuff and that sort of thing. There's a lot of opportunity for people to capitalize on this program.
Okay.
Is that all right? As far as
so let me make sure I understood.
Sure. Yeah, I tried to do it too long. I feel like I kind of went. So
it's all good. Yes, the more information, the better. So just it takes me a minute to kind of catch on to everything. So if I invest $100 today, or by the end of 2021,
right,
and that $100 grows to $1,000.
Sure.
Within 10 years. And at the 10-year point, I paid no taxes on $900. Amazing.
Right. Now that has to be from a capital gain.
Okay.
Okay. So you can't just for everybody who's W-2'd, if you have income from your salary, that's different from a capital gain.
Okay.
So that part is important.
Understood.
Okay. And of course there are reporting requirements and regulatory things that people need to watch out for.
Sure.
And that's a little bit technical.
Okay.
But the plain English version is pretty much what you just said.
Sure.
Yes.
Okay. And you brought up a good point. Caveat, everyone. Please reach out to your attorney and your accountant for all of this advice.
Absolutely.
For your capital gains knowledge, as well as how to set up your entity in that opportunity zone.
Correct.
Okay. Attorney and accountant, two most important people, critical people to set up this opportunity zone venture.
Correct. Can't stress that enough, right? Because even currently, there's regulations. There's been guidance that's come out from Treasury. It's expected that there's going to be more guidance coming out from Treasury. There are staff statements that have come out from the SEC.
Sure.
And with these sorts of things, kind of like what we saw with cryptocurrency.
Okay.
Right. So it wasn't that long ago. A lot of people were launching, initial coin offerings, ICOs, around different offerings of cryptocurrency. And some of these people, had a tremendous amount of star power and influence.
Sure.
And maybe they may have had, one or two people go through the thing, but weren't properly set up. And some of them got jammed up and got sued and had to settle.
Wow.
Right. So, and some of the people that happened to had very deep pockets, they were fine. It's not going to stop their show.
Right.
Not everybody's in that boat. So it's important, again, as Christina said, consult your attorney, consult your tax professional. If you have an investment advisor, a financial services professional, make sure you engage all three of those people so that they can help make sure that you structure this properly or get with the right organizations to structure this sort of thing properly.
Amazing. Okay. So next question.
Sure.
I heard at one point this is a tiered program. So each year that goes by, the opportunity to receive the 100% tax benefit decreases. Is that true or false?
I haven't heard about the 100% tax benefit decreasing. What does decrease is the step up in basis.
Okay.
Right. So how I mentioned earlier about you have $100 after a period of time, you only have to pay taxes, capital gains taxes on $90 or $85, depending on when that happens.
Okay.
So that part, as time goes on, is going to decrease.
Okay.
And for that, there's just a little bit of background, right?
Okay.
So the law was passed in 2017 as part of the Tax Cut and Jobs Act, popularly known as the tax cut bill that Republicans in Congress passed into law, and that the president signed into law. Okay. Now, this was introduced as bipartisan legislation between a Republican, Tim Scott of North Carolina, and a Democrat, Cory Booker of New Jersey. Right. Now, the idea was to incentivize a large amount of investment into lower income communities over a compressed period of time. That was pretty much long and the short of it. There are places that need a lot of revitalization, that are being hit hard by all sorts of socioeconomic and systemic issues. How can we get the most amount of money into these places right now?
Right.
And that was the idea behind this legislation. The end product is not 100% that. And I'm sure some of your listeners, some of your masterminds probably have some comments and some questions about that. The end product is not 100% that. It isn't. But that's the idea. And so the idea is the earlier that you get in, the higher benefit that you have. Like investing in any kind of a company.
Understood.
Right? If you invest, before seed rounds, Series A rounds, you're probably going to have a higher potential for upside and a higher runway of growth than you will when the company's gone public. That doesn't mean you can't still make a tremendous return. It's not going to be the same as it was if you got in very, very, very early. So.
All right. Perfect. Well said. Okay. Thank you for that. Next question. How does opportunity zones benefit real estate investors?
Fantastic question. So for real estate investors, they often have, especially if you dispose of a property. If you bought, let's say, a home or an apartment building or something like that, popular form of real estate investment especially for individuals, is flipping. Right. So you get your hands on an undervalued asset. You add value to that asset. You then exit that asset via sale at an appreciated value. In theory, right? This is the again trying to make it very simple for understanding. The gain on the investment is a capital gain. And once that is realized, you are liable for taxes on that gain. That's just the way it goes. A lot of real estate investors, what they will do is what's called a 1031 exchange. And what that is you buy a like-kind property. And then you can defer the taxes. You put the investment in there, you're not paying taxes immediately. You defer that tax liability. You have that investment in there. You do it all over again, then you do it again. So essentially it's a form of musical chairs where you're trying to keep jumping into a chair before the music stops.
Understood.
Right. So that's
to the 10 years.
Well, so this is 1031. I'm gonna get I'm jumping right back to the opportunity zones. So what opportunity zones allow you to do is that if you have it in, let's say, a piece of real estate, right, that's in an opportunity zone, and you've fulfilled everything you need to satisfy the requirements of that opportunity zone as well as where it's located, and you hold that in there for 10 years or more, once you exit, once you get out, right, the gain on that investment you're not liable for. Right? So With a 1031, this is the difference. 1031 opportunity zones, right? Because some people will ask that.
Sure.
Well, why don't I just do a 1031? Why
Right.
don't I do this, right? I can like kind, I don't have to worry about all this other stuff.
Right.
And you're right, you don't have to. But eventually you're gonna owe taxes on the whole thing.
Okay.
Eventually, unless you keep it going forever, which some people do.
Sure.
But if you don't, you're gonna owe taxes on the whole thing. This is, once that 10 years is over and you exit, I wanna take my cash out.
Sure.
Right? You're not gonna owe taxes on that gain. And the initial investment will be, depending on when you do it obviously, the amount of the initial investment is gonna be taxed less.
Okay. So for a real estate investor, would they have to convert that piece of real estate into a business, so to speak? So say, I was interested at one point in converting a residential property into an ALF, an assisted living facility.
Okay.
So would that real estate investor have to convert their property into another useful property in order to take advantage of an opportunity zone benefit?
No.
Okay. So they could just have the house, they could either live in it or rent it, and as long as they sell it after the 10 years, take advantage of the benefit.
So I would focus more on investment properties than
Okay.
necessarily permanent residences.
Gotcha.
Obviously some people will live in a part of an investment property and then have the rest of it generating income.
Okay.
Again, consult your accountants and tax professionals around that. But sticking with the investment standpoint, you don't have to necessarily. I mean, if you choose to, that's your business.
Sure.
There are certain businesses that are off limits.
Okay.
Like liquor stores, golf courses, country clubs, tobacco places, casinos.
Okay.
Those sorts of places wouldn't qualify.
Okay.
But beyond that, residences, multifamily residences, that sort of thing, 100% qualify.
Okay.
You don't have to necessarily convert it into something that's other than, a multifamily residence or a number of single-family residences, however they may be,
Sure.
in order to capitalize on that benefit.
Okay.
And in fact, that's part of the reason why a number of the larger deals that are being done right now, there's a large amount of multifamily deals that are being done right now because of that very fact.
Sure. Okay. Understood. That's perfect. Thank you for that.
You're welcome.
All right. Let's move into the next question.
Let's do it.
Would you say that opportunity zones are selected for growth potential or hot areas for investors to invest in, whether it's to be an opportunity zone investment or just an ordinary investment?
Great question. So, yes and no.
Okay.
Are they selected for growth potential? In some instances, yes.
Sure.
Right? There are areas all across the country that we know of that have been changing,
Okay.
that have been gentrifying.
Sure.
Right? And from a neighborhood standpoint, that means the neighborhood is not what it used to be.
Sure.
People who used to live there for an extended period of time may not be there anymore for a variety of reasons.
Sure.
Various institutions that used to be in these neighborhoods may no longer exist for a variety of reasons.
Okay.
Right? When that happens, part of the reason why the people who invest in those places do is because they believe they can add value and that other things are going to take place in those areas that will add value,
Okay.
that will cause the value of those investments to increase, in some cases to increase dramatically. We say it all the time, right? You see a Whole Foods,
Sure.
or you see a Starbucks, certain different things, then the neighborhood's changing.
Okay.
The value is coming, right?
Sure.
We've seen it in different areas of Washington, D.C.
Gotcha.
Certainly we've seen it in different areas of New York, right? Where, different parts of Harlem, different parts of Brooklyn, Queens, the Bronx.
Okay.
Washington, seeing it in Southeast D.C., different parts across the Anacostia River that, were considered no-go.
Sure.
All of a sudden are becoming very trendy and people are moving into.
Understood.
So there's growth potential there that investors and people are looking to take advantage of.
Okay.
Now, to the second part of your question, there are definitely hot areas that have been designated as opportunity zones
Sure.
that are not necessarily within that lower income strata and that lower income description.
Okay.
Right? Where there may be deals that have been in the works for some time
Sure.
that were okay, they were good, they weren't amazing. And then this opportunity zone legislation with this tax benefit came in.
Sure.
People ran the numbers again and then determined that this was a very attractive investment.
Okay.
And then that would cause people to invest, or institutions, companies, various funds, etc., to invest in these places where they might not traditionally.
Okay.
And we've seen that a lot with a lot of foreign investments.
Sure.
Right? If you're coming out of China or coming out of Japan, different parts of Europe, Africa, etc., more often than not, if you're going to invest in the U.S., particularly if you're talking about real estate per se, you're going to invest in a core market. You're going to look at a New York. You're going to look at a Washington, D.C., Los Angeles, Chicago, Miami, what they call tier 1 markets. There are others beyond those, but I just list those because those are some of the ones that people know about.
Right.
And there's landmarks and things that people are familiar with.
Okay.
Right? You can have never step foot in the U.S. The seat of power in the U.S. is Washington, D.C.
Exactly.
And that the seat of the financial world is in New York.
Sure.
The seat of the entertainment world is in Los Angeles.
Right.
These are things that are standardized, that exist.
Okay.
Right? With this tax incentive, other areas that may not have been looked at before all of a sudden look very attractive.
Sure.
So if you're talking about like a Jacksonville, if you're talking about a Baltimore, which I would also consider to be right around a tier 1 city, but hasn't had the same level of attraction from an investment standpoint that, say, a Washington, D.C. has had. Opportunity zone legislation that says, okay, this deal that I'm looking at that's a so-so deal or a good deal, not only am I going to get a good return on this, my tax liability is going to be severely limited, and the tax liability around the appreciation on this investment could be eliminated entirely. That makes something very, very attractive.
Okay.
Right? So because of that, people are going to take a closer look at it.
Okay.
So that's going to impact, areas that are designated for growth.
Sure.
And areas that are, maybe they're on the cusp, or maybe stuff's already happening. It's going to affect both of those places.
Okay. Perfect. So that leads me into this question.
Sure.
Now, it was difficult for me to find a map for the designated opportunity zone areas in my city. Is there somewhere people can go to identify these areas so they know where to plant their flag or make an educated decision for their investment?
Sure. For most places, your city government, their various websites will have different tools and maps that show where opportunity zones are.
Sure.
Some of the more further along ones will allow you to key in different addresses and locations to determine whether or not that location is within an opportunity zone, and it'll tell you straight away.
Sure.
This is going to vary from city to city.
Okay.
But the best guess to begin from most places is your city government's website.
Okay. Website. Okay, got it. All right, thank you for that detailed information.
You're welcome.
Next question. Can you give us an example of what an opportunity zones deal looks like and how it's structured?
Okay. So I will use, there was a deal I was talking about when I was down in Jacksonville.
Okay.
That is a multifamily deal. It's about an $86 million deal. So to step back for a second, whenever someone goes out and buys a house, 9 times out of 10, they're going to have a certain amount of money that's used as a down payment.
Sure.
And then the remaining amount of money that's required for that house will be a mortgage that is traditionally acquired by a bank.
Okay.
So there will be a small amount of equity, generally somewhere between 3 and 5%, depending on the person's situation.
Okay.
And then the remainder of that will be debt,
Okay.
which is taken from a bank. You have to pay that back at some point.
Sure.
Right? An investment deal is no different. The only differences are, A, the amount of equity,
Okay.
both in just total size and in percentage of the deal itself,
Okay.
may change. The number of institutions and individuals that participate may also change.
Okay.
So in this deal, this was an $86 million deal. Okay. There were 2 lenders on the deal. There were 2 different banks that lent a combined total of $51 million.
Oh, wow.
Okay, so just doing the numbers here, right?
Sure.
So 51 out of 86, you're talking about $35 million that's left.
Okay.
Right? Now in any deal, there's generally going to be this varies obviously from deal to deal.
Sure.
Complexities, are going to change. But generally, you're going to either be talking about debt,
Okay.
or you're going to be talking about equity, right? So debt, straightforward.
Sure.
Someone lends you money for something.
Right.
You have to, with agreed upon terms, agreed upon interest, and within agreed upon time, you have to pay that back.
Okay.
Equity. There is an investment on a percentage of a business or real estate investment,
Okay.
with the expectation that that will grow or generate some sort of income.
Sure.
And that investment of equity, depending on the percentage of how much it is and the structure of the deal, entitles the person who invested it to a percentage of that growth,
Okay.
and or to a percentage of income that comes from that business or real estate investment.
Okay.
Right? So most of these deals are privately done. And because of that, that means one is not going to get to see all of the ins and outs of the deal, what they call the capital table,
Okay.
or the capital stack.
Sure.
Right? Which basically means how much of what percentage of debt or equity is going to make up that total $86 million.
Okay.
So when people talk about like a capital stack, that's what they're talking about.
Okay.
So we know the debt. We know that. We know that there's $35 million left over.
Okay.
We know that a hedge fund out of Washington
Sure.
invested in that deal as an opportunity zone deal.
Okay.
We do not know how much they invested, and we wouldn't know unless we were one of the investors or had access to their documents.
Understood.
Right? Because it's not public, it's private information.
Sure.
So their investors have a right to know, right? And those who handle that sort of disclosure, the Securities and Exchange Commission, better known as the SEC,
Okay.
they're going to make sure that their investors know.
Sure.
Because if you don't disclose, then you're going to run into trouble.
Right.
Right? But as far as the general public, the general public is not going to know much beyond the broad parameters of what I have just said.
Okay.
But that is a real deal.
Okay.
It is a deal that happened. There are shovels in the ground. There's
Okay.
construction happening.
Sure.
A building is going to go up by the end of 2020.
Okay.
And it's within an opportunity zone.
Okay.
And it's valued at $86 million.
Understood. Okay. So tell me this. Can the ordinary girl next door take part in an opportunity zone, or would I have to set up a syndication?
So to participate in an investment within an opportunity zone, it must come from what is called a qualified opportunity zone fund.
Okay.
Okay. And this part is important. Now, technically, you have to set up only an LLC,
Okay.
limited liability company,
Sure.
or a limited partnership
Okay.
as an entity. And through that entity, you can then invest in qualified opportunity zone businesses or qualified opportunity zone investments.
Okay.
There is an SEC component to that,
Okay.
right? Now, the SEC put out a staff statement.
Mm-hmm.
In that staff statement, they said this is not an official, doctrine,
Okay.
but, caveat emptor when it comes to this sort of thing, I would, if they're allowing their staff to put this out, I would
Sure.
say that the SEC is probably going to look at this very closely as these investments get rolled out
Okay.
and as things go on. And what they said was they will treat qualified opportunity zone funds as securities.
Okay.
And what that means is they regulate the sale and purchase of those securities.
Okay.
Which means you either have to be, that fund, that entity, whatever it is, either has to be registered with the SEC,
Okay.
or it has to be exempt from registration
Okay.
with the SEC.
Ah.
There are certain laws that exempt registration and certain designations and characteristics
Sure.
of entities that exempt designation.
Okay.
This is where your attorneys and accountants, once again,
Right.
super important, because
Right.
they know this stuff.
Sure.
Right? And not doing this properly can get people in a lot of trouble.
Absolutely. We don't want anyone in trouble.
No, we don't want that. Not at all. Not at all. Very important. So, having that in place is the vehicle,
Okay.
right? Now, once that vehicle is in place, that vehicle can either purchase real estate
Okay.
or invest in what's called a qualified opportunity zone business. Okay? Now, a qualified opportunity zone business generally is going to be located within an opportunity zone.
Okay.
They're generally going to have a large amount of their business,
Sure.
or a large amount of their staff, either located within or doing business within an
Sure.
opportunity zone.
Okay.
Right. So if they do that, then that investment, will count as an opportunity zone investment.
Okay.
And a qualified opportunity zone fund, for it to work, 90% of the fund of the assets that they have under management, they have to deploy into opportunity zones.
Okay.
Right. So it can't just be a thing that you get these capital gains, you put it into this fund, because we're in this fund, we're okay, we're going to potentially qualify for this tax benefit.
Okay.
No. The money has to be deployed.
Sure.
It has to go out into investments in businesses.
Understood.
The overwhelming majority of it, 90%, must go out.
Okay.
Right? And it has to go out within 6 to 31 months. So it gives you time to evaluate deals,
Sure.
evaluate investments, because of course, yes, the idea is to uplift various communities,
Right.
but the reality too is that individuals and institutions want a return on their investment.
Understood.
They want to know that these funds are going to be able to get them more money than they themselves would get doing something else or holding on to the money.
Okay.
Right? So deals are going to be evaluated through that lens, and that takes time.
Okay.
So the regulations keep that in mind, but again, they have to invest in it.
Sure.
Right? So the short answer, can the girl next door do this?
Yes.
If the girl next door knows how to, or has access to people who know how to set up the proper vehicle so
Okay.
that not only it's compliant with tax law,
Sure.
it's also compliant with the securities law, then yes, absolutely.
Okay.
If she also has capital gains.
Okay.
Right? If not, probably not.
Okay. Short answer.
That's the short answer.
Okay.
I'm trying to keep these condensed, but this is complex stuff.
Absolutely,
right? And,
yes.
some of it it's like how do you explain nuclear physics
Sure,
really quickly?
yeah.
You don't explain nuclear physics really quickly.
Right.
You don't. That's just how it is.
Absolutely.
So,
Well, I met Myron at the Jack's Urban League, and he put on a phenomenal presentation, very knowledgeable, and we had an opportunity to get him personally one-on-one to kind of break down what an opportunity zone is and who can participate and how you can take advantage of this extraordinary tax benefit. Myron, I'd like to thank you.
it's my pleasure. Thank you for having me.
For sure.
Thanks for welcoming me, guys. I appreciate the opportunity to talk to all of you.
Absolutely.
And it's a tremendous opportunity, tremendous potential benefits. Make sure you consult your professionals. Make sure to evaluate deals and potential investments stringently. This is not going to make deals that are terrible all of a sudden amazing, but it could give deals that are kind of on the fence that extra push to become a little bit more attractive. So, happy investing, happy participation, and best of luck.